Good morning, everybody. Garrett Baldwin. It is 8:15 on April 15th. It is tax day. I hope everybody's having a good morning. Um, you do what I do. You can just wait. You can delay it. Just pay everything, but then delay it, and just eventually you'll get around to it. This is quite an interesting event, quite an interesting market, as we all know. But we're going to dive into quite a bit today. We have a lot of changes coming. We have a lot of things happening. We have the possibility of a sizable liquidity drain that may come as well. This is your morning BRRR. The Associated Press is reporting that both sides are, well, here we go, in principle agreement to extend the ceasefire another 2 weeks. That's the carrot. The stick is the Pentagon is sending thousands more troops, and that the military says ground operations remain on the table if this ceasefire does break. We're going to talk about what's happening with luxury. We're going to talk about Hermes, Kering, some of those other names. Two big banks beat yesterday. Bank of America, 111 versus 101 estimate. Okay, pretty good. Before the bell, what are we doing? Well, we're going to try to get our traditional PowerPoints to work the right way. That's the first thing, right? We got a data cluster, 8:30 Eastern, the Empire Manufacturing Index and the import-export prices come. These are the first tariff error reads, pre-July snapback per Treasury Secretary Scott Bessent. Everyone's watching the import number, okay? Tariff pass-throughs is the inflation story that people are going to start talking about in the next 24 hours. At around 10:30, we're going to get the EIA's Energy Information Administration, their crude oil report. So this is the post-blockade print that came. The API overnight showed about a 6.1 million barrel crude build versus minus 1.3 million, which was expected. So sizable build. That's an inventory build despite the Iranian situation. And once again, a reminder that demand destruction is really here. 2 o'clock, the beige book, the Fed speakers will be hitting the tape. Barr, Bowman, Hammock, 11:30. British summertime, everybody. Trump will sit down with Fox News, look for border and talk trade to dominate that. We have Lagarde, Bailey, Green all weighing in over in Europe as well. And the consensus from central bank is they're in a good position to respond, and it's too soon to look through this shock. So 2 more weeks. All right, 2 more weeks. Now, before we get to 2 more weeks, let's take a little bit of a step back and let's actually look at the current state of the market this morning, give you a little bit of futures numbers, get you understanding and really excited. Oh, just thrilled. This rally just will continue. S&P 500 up this morning once again, looking at the SPY, which has been going a little bit parabolic. This buying frenzy started about 2 weeks ago, and it has been significant purchases from CTAs, a momentum-driven rally. Our cap-weighted number turned positive April 6th. We broke above the 20-day moving average on the SPY. On April 6th, the SPXL going above its 20-day moving average. On April 7th, this matters. That is a key momentum figure. That is a key momentum line. And you're looking at the SPXL. Someone asked a question. Why do you look at these things if they're leveraged? Shouldn't you be looking at the traditional metrics? Isn't that a cleaner way of looking at momentum? Yes, it is cleaner, but here's the key thing. The leverage is what matters. The leverage is what all of the basis trade and all of the leverage funds and all of that capital. This is how you end up in these situations where you wake up and all of a sudden one of the greatest stocks in the world is absolutely getting pulverized. Why? Because it's bought on margin, because it's basically utilized through leverage and the capacity of how these markets operate. And when the leverage unwinds, because there is some sort of repo event, some sort of financial event, some policy event, trade, whatever it is, the high beta, heavy weighted stocks that are bought on margin, they unwind and they unwind quickly. Remember, we see in financial events, when we see a spasm happen, we see treasury bills get sold first. They're the most liquid thing in the world. So that basis trade unwinds. And then what goes? Stocks like NVIDIA, right? Stocks like NVIDIA. And I remind you, in November, when we sold off in November, thanks to Japan, NVIDIA went from 211 all the way down to 170. Did anything change in the thesis around NVIDIA? Did its capital efficiency get any worse? No. This is a heavily purchased stock, lots and lots of leverage. And as you're seeing, NVIDIA coming all the way back from 165 to 195. You need another example of this? Go back to 2024 and look in August when we had the Nikkei crash. This stock lost 33% of its value in less than 2.5 weeks. The thesis of NVIDIA didn't go away. It was the leverage in the financial system, the leverage in the equity markets that pulverized this. So it is very important to watch the SPXL around that 20-day moving average, the FNGG, which I talk about almost too much, the Direxion Daily, broke above its 20-day moving average on April 7th. And you're going to find that our readings typically align somewhere in that range, typically a day or two below, because we start to see the cap weighted number push higher and into positive territory before equal weighted numbers turn positive. So yeah, I have hated this rally. I find this rally to be a little crazy. I look at what's happened with the CTAs and the amount of buying that they've done. But these V-shaped recoveries are coming, and they're coming quick. And it's very important to watch things like the FNGG, watch the VIX, watch the MOVE Index. And I'm going to tell you right now, we're sitting near overbought. We are sitting near overbought right now, and we're coming on the backside of tax season, and the backside now, April 17th of Third Friday. Everybody's now chasing this rally. Now the question is, now that the CTAs have had a hell of a 2-week run, do they try to now hand this off to retail that is getting more excited about ongoing macro and ongoing moves heading into earnings season? All right. So we're going to continue with this, and we'll talk about that 2 more weeks. All right. So once again, the AP have reported both sides in the principle on extending the ceasefire 2 more weeks. Vance is positioned to lead round 2. Trump had said in a statement that a deal is possible by the King's visit April 27th through April 29th. That is the carrot. And then you have the stick. And the stick is that the Pentagon is moving thousands of troops into the region. The Washington Post is reporting additional strikes and ground operations remain on the table if the ceasefire breaks. Treasury markets dipped red on the troop headline. The dollar index did catch a bid, but I do continue to note that DXY move under 98, that is the dollar index, that impacts collateral quality, that impacts leverage, that impacts repo, that impacts positive, and that ends up being positive for equity markets. I talked a little bit about that yesterday in my Money Printer article. Basically, right, a weaker dollar is good news for equities. It's good news for leverage. It's good news for, well, the bulls. The U.S. intercepted 8 Iranian tankers mid-blockade. The Financial Times reporting that Iran bought Chinese spy satellites before the war to target U.S. bases. Pakistan leadership is away until April 18th, which dims the near-term venue for negotiations. But as again, the framework is still there. The chokehold, however, cracked a little bit. 20-plus ships got through Hormuz in the last 24 hours. A sanctioned Iranian, very large crude carrier slipped past the blockade, according to the FARS agency. I don't know the full story of that, but again, it's floating around the ether. Iran is routing through alternative ports per mare. So this is mixed signals. The blockade was announced. It was fully implemented, but leakage is visible. There's about 103 empty tankers inbound to U.S. ports right now, which is wild. 54 very large crude carriers. America is stepping in as a swing supplier. This is significant. Again, as I've noted, when these events happen, you're seeing things change on the fly. You saw how Saudi Arabia suddenly gets 700,000 barrels a day through one pipeline and 10x's that. Right? The markets are resilient. Innovation is resilient. Things get solved a lot quicker than I think a lot of traditional analysts may suggest. And the big question I have right now is what will happen with fertilizer, and will there suddenly be output elsewhere? It's entirely plausible. The reality is now, right, we have tons and tons of crude oil that will be sold by the U.S., that will benefit Japan, that will benefit India, that will benefit a lot of the lost crude. And we went through the math the other day showcasing that in the world of Hormuz, that some analysts are estimating about 17 million barrels are accounted for out of the 20. You have the pipeline, you have different routes, you have pre-war surpluses. Right now, the question is, what is this going to look like in about a month if there is any major shift? So right now, WTI crude hovering where it's hovering. We're sitting right now at 92 25. That is significantly different than the $200 per barrel numbers that you've seen. We have seen some of the spot numbers push into that 150 level up near Dubai, but the reality is that for the most part, the market is being pretty resilient about this at the moment. You watch that DXY down there, that 98 for the USD. That is the number to watch. If that pushes back to 99 or 100, that is going to weigh on equities. That is going to weigh on margin. That's going to weigh on everything. So this market continuing to showcase its resilience, CTA stepping in and bidding. We are now pushing toward overbought. And we're going to see if the narrative changes because, as we know, narratives change very quickly in these markets. All right, moving on to A Tale of Two Tapes. Ooh. Scott, did you write that? We have a luxury collapse right now. Hermes is down 9%. Kering's down 9.1%. One revenue 4.07 billion euros versus 4.15 billion. Eesh. Estimated. Constant currency growth 5.6% versus 5.44% estimated. Asia and ex-Japan, so markets out in Asia outside of Japan, plus 2%, plus 5.8%. That is a huge China miss. France is down 3% on tourist flows. CAC down 0.6%. ASML just raising its full year 2026 guidance to 36 to 40 billion, 36 to 40 billion euros, forgive me, from 34 to 39 billion. This is significant because, again, this is showcasing that demand for chips is outpacing supply and that the AI trade is still clearly in play. That said, consumers are down, compute is up. That is the tape. And it showcases kind of the directional elements of what we are as an economy. Think about the fact right now that consumer spending is under some pressure. And it's not the, I want to make sure that we articulate this right. The bulk of the spending in places like the United States is driven by the top 10%. Like nobody cares about the bottom 90 right now because that's not where the driving is on the economic front. I'm not saying that they don't care about them politically, socially, etc. I'm pointing that the economic numbers are being driven by a very specific group of individuals. And when you start to impact the spending of the 9th or 10th percentage level, that's going to weigh on the equity markets. And once again, with time, the estimate and the expectation is that they're going to lose their purchasing power to the Cantillon effect, to ongoing monetary expansion. They're the people who are making, you're reading these articles about people who are making $200,000, $300,000, $400,000 a year and saying that they're underwater. Yeah, that's going to keep going until it hits people in like the 5 million range in like 5 to 10 years. And I'm not making a joke about it. Like that's kind of how this has operated. This is the basis of the monetary system. It takes from the bottom, it pushes back up, and it is largely on the nature of the way that capital is created, particularly in the post-2008 world. We've talked about the Cantillon effect. We've talked about the way the capital is created. It is going to go until it breaks. Big banks are beating as well. Bank of America, 111 earnings per share versus 101 on the estimates. Profits up 17%, revenue 30.3 billion. Investment banking up 21%. Everybody's doing well. All the banks have done great on the trading side. Trading revenue up 13%, stocks plus 30. And of course, fixed income short of street estimates. Well, not terribly shocking, but the stock is up a little bit pre-market. Morgan Stanley on the other side, crushing earnings, 3.43 versus 3 estimated. Revenue up, beating revenue by about $800 million. Both lines above street. Wealth management, still the core engine. of their business. Investment banking fees recovering over time. Again, the capital market momentum is holding and sector rotation tailwind into financials. We've seen this on our readings. Financials have been the top performer out of all momentum in the last week and a half. And I remind you, if you are watching the banks, right, same rule applies, same thing, right? We talked a little bit about the FNGD, but I also always mention the FAS and the FAZ. And the FAS is the triple bull ETF around financials. Now, this is important because this is everything in the space. And we've seen a lot of weakness persisting in private credit and what's happening in insurance. But watch the FAS broke above its 20-day moving average. Can you hear me in the back? Broke above its 20-day moving average and has continued to scream higher. On the other side of this, BNKU, which is the ETN that's linked to banks, screamed above its 20-day moving average back on April 2nd, and it has been blue skies ever since. All right, we got a couple more of these to go, and then we will wrap it up and then start our trading day. Key thing here is this $300 billion storm. Hey, everything looks great until somebody gets punched in the face. It is tax day. The Treasury projects that the Treasury general account is going to spike to $1.25 trillion. That's a $322 billion build out. Overnight reserves drop from 3.2 trillion to 2.8 to 2.9 trillion. Okay. Zero reverse repo buffer is left in this market. So the Fed Treasury bill is buying slowly from 40 billion to 25 billion monthly. That has been that winding that we have discussed. Now, the SOFR and interest on reserves are already down 2 basis points. The history lesson here is that in 2022 and in 2024 and in 2025, we all saw S&P 500 weakness after the tax day TGA spikes. So watch overnight rates. This is not just about price. The tax deadline creates a liquidity vacuum, and it happens every year, and it tests credit availability. And this is one of the reasons why people are always nervous around this day. So until liquidity reverses the rallies, oxygen thins. We are sitting overbought, which is, again, a reminder that these things can move quickly and move fast. And then all of a sudden you see a bit of a rug pull. I have seen a lot of people suggest this is a major bull trap. I have hated this rally because it just has, something has felt very off. And I do question, and this is just a morning statement, I do question if something else happened. I do question if there is some other policy response that we're not seeing, because this is one of the first rapid recoveries that we have seen that did not incorporate a significant amount of insider buying. But insider buying has been stretched over the last couple of weeks. We saw it with BDCs. We saw it with a number of consumer retail names. Again, this feels very reminiscent of 2022. We are in a speculative phase. We are starting to shift toward that period where you want to focus once again on the stocks that we've talked about in postcards from the edge of the world, the things that can address what I think the real core issue here is, the prospect of stagflation. Finally, let's get into this fun time. Bank of America financial surveys showing growth was the lowest since 2022. Shocking. We've talked about 2022, haven't we? Inflation pessimism is the highest since 2021. Sentiment is the worst since last summer. And Mike Hartnett at Bank of America is saying this is a not close your eyes and buy market. Treasury Secretary Bessent says growth could exceed 3 to 3.5%. And I do have to stress the idea here that we're going to be selling a lot of crude oil. And one of the things that we have to go back and look at during that period that prevented the United States from falling into a recession, I believe it was 2022, 2023. That was where the United States was exporting crude. And interestingly enough, the way the GDP was calculated, they were effectively getting a benefit from the production of crude here in the United States, but they were also getting the benefit of the exports because, again, the equation of GDP is business, consumer. Why am I blanking on this at 8:00 in the morning? One more point. What is the number? Oh my gosh, we got to do this. I've completely crapped out this morning. This is where I would be turning to Becky Quick and say, hey, you answer this. You're going to watch me figure this out in pure time. Expenditure, income, or production is consumption, investment, and government spending, and net exports. We benefited from net exports. And you know what? I'm not going to cut that. We're just going to show that I'm an idiot sometimes at 8:30 in the morning. And then no matter how many economics degrees, you will forget this stuff because it was all taught to you out of one bloodshot eye before 9:30 in the morning. All right, that said, man, that's tough. All right. Treasury Secretary Bessent, growth could exceed 3.35. Okay. So Lagarde and Wren from the ECB saying they're in a good position to respond. They're saying that tightening is not guaranteed, and the market is obviously looking for that. The bull tape versus the bear survey, the data is running in one direction. The sentiment is running another. That gap usually closes, and it usually closes pretty badly. So just be aware we have a lot going on. The fog is still clearing. We have a treasury probe going on right now in terms of private credit for business models and ties to the regulated financial system. Per Punchbowl, Ares Management CEO has said nothing that would say a major default cycle, but $20+ billion in Q1 redemptions is significant, and PNC has reported $7 billion in exposure to private credit as well. BlackRock's chief Rick Lord saying it's volatility, not a bubble. The fog will clear. $1.8 trillion market up to $3.5 trillion, depending on where you sit. The regulatory probe signals that the Treasury believes credit quality is at risk. Hartnett's survey is showing inflation pessimism, which again brings up my concerns around stagflation, and that can mean default rates can start to shift as well. All right, so stuff that we are going to be paying attention to today. Real quick on the mover side, let's pull that up real quick. One second. All right, we're currently updating some numbers here. Move over to Elite real quick and pull up our conviction engine. We are looking at the stocks that are moving in the strongest momentum across 8 different momentum scores: Intel, Corning, Keysight, Monolithic, and Jabil, FedEx, Seagate, AMD. So a lot of technology continuing to drive this bus. On the downside of momentum, we are seeing continued pressure in the regional banks, in names like Visa, Apollo. The private credit is still all concern, and of course the insurance names. So this insurance issue has not gone away. I do continue to stress the importance of following this. The other thing, just noting that consumer defensive still facing pressures because of rising food price expectations heading into the end of this year. That impacts margins, of course. All right, finally, on our catalyst side, last things that we need to know before we start our day. Today, we have the Empire State and import-export prices. These are the first tariff error reads pre the July snapback. EIA crude post-blockade print comes at 10:30. Trump will speak at around 11 o'clock with Fox. At 2 p.m., the Beige Book with multiple speakers from the Fed. We have a blackout that I believe starts on Friday. The ceasefire extension, 2 weeks in principle. The Pentagon is still sending troops. We have a $300 billion TGA build out. Watch for SOFR and the spread on the Fed funds rate and repo rates. TMC full earnings will be tomorrow. TSMC earnings will be tomorrow. Earnings and guidance. This is the key AI data read for the next couple of weeks. And of course, the King of England will be joining us for 3 days. We will see what happens there. All right, everybody, you got to watch me have a little bit of an economic meltdown. That was fantastic. And as always, if you have questions, you know where to reach me. Hit reply, send me a note in the comments, and we will go from there. And I promise we will do a much better job and represent the economics departments of Hopkins, Purdue, and Indiana tomorrow. Everybody take care. Stay positive.